At this point, many people are wondering when inflation will end. Over the past few months, we saw the Consumer Price Index, CPI, rise at a rate not seen since the 80s. In March, the official increase was 8.5% compared to the previous year, thus making a record in 40 years. Even stripping out volatile food and energy prices, the core CPI, as it's known without those two values, remains extremely high at 6.5%. Everybody is worried. Matt Perron, research director at Janus Henderson Investors, commented that inflation has probably peaked, and now it's time to ask how long it'll stay up and at what rate it'll decline. The pandemic, supply chain disruptions, high demand, the war, the resource scarcity, and other factors contributed to the increase in the CPI. On the other hand, there is the Federal Reserve taking drastic but necessary economic measures to curb inflation. What would happen if these problems are not resolved in the short term? Will the US economy fall apart? What other actions does the Fed have in mind to curb inflation? What are the projects for the rest of 2022? All these questions and more will be answered in this episode, so let's get started. Hello everyone, and welcome to Novarise, your channel for financial education. Don't forget to subscribe and to like this video for more content. Inflation in March 2022. 2022 has been a dark year for the global economy, and March was particularly worrisome. The high percentages of the Consumer Price Index surpassed the most alarming projections for this year, and the future outlook does not seem to be very encouraging. General prices rose 1.2% in March. Food increased by 1.5%, which brought the annual inflation rate for this sector to 10%. The most alarming increase was the price of gasoline, which went up by 18.3%. Yet the price is expected to return to normal levels in May. Rent prices also went up with the expiration of the rent moratorium and evictions. Clothing prices continue to rise, particularly due to the high value of shipments and imports. The shortage of computer chips is still a problem, leading to a 2.8% increase in home appliances. One of the few markets that recorded declines was used cars, with prices falling by 3.8%, although it's still 35.3% higher than a year ago. So far, everything looks depressing, but what do the experts say? Projections. The International Monetary Fund expects the world economic growth to slow down this year. This is mainly caused by the war. According to the IMF, the global economy is expected to show a 3.6% growth this year, after reaching 6.1% last year. This is a surprising figure when you take into account the aftermaths caused by the pandemic. The worst part of this is that this projection has been decreasing. In October of last year, a growth of 4.9% was expected in 2022, and in January of this year, it was set at 4.4%. This shows us that even though 3.6% may seem bullish, it can still continue to decline. Even more alarming, the IMF projects economic growth of around 3.6% by 2023, which seems to indicate that the economy problems will continue for at least a while. For now, the economic recovery scenario does not seem to be encouraging, and the internal conditions in the US seem to lead to more inflation. High demand may continue. During 2021, a record 6.7 million jobs were added to the US workforce, and in January of this year, new jobs reached 467,000. Now, what does it have to do with inflation? It's simple. The more people work, the more salaries they'll earn that would allow them to spend on non-essential products. Because of this, high demand will remain at levels that companies will not be able to satisfy. Wells Fargo senior economist Sarah House said it won't be that easy to get inflation to stop at the level that the Federal Reserve expects. Wells Fargo projects that by the end of 2022, the CPI will still be above 4%, which is still far from the Fed's ideal 2%. President Joe Biden acknowledged that inflation is high and said that his administration forecasts that the index will substantially moderate by the end of the year. Sounds optimistic, but the message is neither clear nor encouraging. What was initially considered a transitory problem by the chairman of the Federal Reserve, Jerome Powell, has now been established as an ongoing situation in the U.S. economy. A Gallup poll earlier this year showed that an overwhelming majority of Americans believe that high inflation rates would continue for at least 6 months. And so far, these assumptions appear to be very real. As for the question, how long will the CPI continue to rise? First Bank advisor David Frederick commented that it's probably time for inflation to start slowing its growth. The same projection is made by the financial consultant Chet Price, who believes that the inflationary situation will change for the better in the last quarter of the year, when the CPI returns to relatively normal levels around 2.3%. So what should we expect next? Next steps. We already saw how the Federal Reserve recently raised interest rates, a move they hadn't taken since 2018. When the pandemic represented the maximum economic threat to the US, the Fed decided to take interest rates to levels close to zero in order to promote mass consumption and try to keep the economy moving. Of course, when everything started to normalize, this measure was more of a problem than a relief, as demand began to outpace businesses. For this year, there are several meetings scheduled at the Federal Reserve to discuss the economic outlook, and of course, interest rates. For the next meeting in May, interest rate values are expected to increase again, at least by half a percentage point. For the following meetings, interest rates are also expected to continue to increase at least by half a point. According to analysis by Goldman Sachs, the Fed is expected to raise interest rates 4 more times this year. At the same time, the Fed is expected to start selling Treasury securities backed by its balance sheet starting next month. And these kind of measures are intended to take money out of the economy as a way to curb demand. The goal is to make people more aware of how they spend their money, in hopes to curb the high demands to allow the economic recovery to take place. Future impacts. One of the objectives of the Fed is to avoid the risk of increasing expectations about price increases, which would almost force companies to also increase wages, generating an inflationary loop that would be even harder to contain. One of the expected economic impacts is that short-term interest rates will rise along with the Fed funds rate. Rates on home equity lines of credit are generally tied to the Fed funds rate and move in a similar way. Short-term consumer loan rates, such as auto loan rates, will likely take a hit as well. Long-term rates, such as mortgage rates, are not directly affected when the Federal Reserve raises short-term rates, but they can still rise due to inflation. By the end of 2022, 10-year bond yields are also expected to rise by 3%. The same is expected of 15-year fixed-rate mortgages, which may go from 4.2% to 4.7%. Of course, if the economy quickly gets on a better track, rates could ease a bit by the final quarter of the year if the Fed considers that progress is being made with regards to inflation. The biggest problem today seems to be that there is too much newly created money in an economy that cannot support the high demand for products and services. That's why inflation is at such a high level. According to Federal Reserve balance sheets, during the Great Recession, the Fed added about $2 trillion to the economy between 2008 and 2011. In today's case, $6 trillion was added to the economy during a period of 18 months. starting from March 2020, causing inflation rates to skyrocket. Given all that's going on, what should we do to protect our money? Some financial experts are very clear on their view. Max My Interest CEO and former banker Gary Zimmerman has some clear advice. It's time to buy real assets. He shared that real estate is a highly profitable asset during an inflationary period, as its face value will increase while the real value of mortgages will decrease due to inflation. Financial advisor Chad Price also said that savings can help you offset the effects of inflation. He believes that people who want to hedge against inflation can invest in high-yield savings accounts and withdraw their cash before inflation rates decline. If you're a business owner and thinking about expanding your business, this may not be the best time to do so. Bob Castaneda, director of the School of Management and Technology at Walden University, shared that if interest rates continue to rise, perhaps the best option for business owners is to try to reduce their financial movements and expansion plans, at least for a few months. This is due to the fact that mass consumption could decrease in the coming months, causing production to slow down as a result of the drop in demand. Yes, we're going through difficult times, but this won't last forever. Until now, the Federal Reserve is taking the necessary measures to try to control inflation, and although the Consumer Price Index is expected to remain high, it might be at its maximum peak. For now, all that remains is to continue to be cautious, closely monitor the decisions made by the Fed, and try to get the most out of our money and investments. How have you protected yourself from inflation? How much longer do you think the high prices will last? Leave your opinion in the comments. And don't forget to check out this episode that's gonna help you complement everything you just learned today. Bye bye!